Welcome back, learners, to the world of economics. I, Ritu Gupta, shall be taking you through the topic saving and insurance. This presentation is going to give you an insight into saving and also into insurance. Let us begin. Ready? In this session, you will learn the meaning of saving, the need for saving, use of saving, the concept of interest, insurance, its meaning and need, about life insurance, health insurance and automobile insurance. So, let us now understand the meaning of saving. As we can see, saving is like a bank, a balance which can be used as and when desired. What is saving? Saving is the amount of income which is carried forward to future after meeting the current expenditure on goods and services and other things that we need in our day-to-day life. As we can see here in a equation form, saving is income minus consumption. It is denoted as S, income as Y and consumption as C. So, S equals Y minus C. Saving gives a base to increase future income. They act as economic security for future ups and downs. And yes, we do save for contingencies. How do savings help us? As we can see through these pictures, they give us certain delights in the future for property, for vehicle purchases and so on. Now, what when savings increase? Savings, when they increase, the future income of the person also increases. I repeat, saving increases the future income of the person. Secondly, saving can act as a kind of security for the future, and hence it is important to save. Where do we keep our savings? Generally, people keep their savings informally at home as cash. Now, this cash is idle. This does not earn a reward and also it is not safe. Hence, institutions have been formed wherein people can park their savings. Where do we keep our savings? In a piggy bank? No. As electronic media? Yes, but not to that great an extent. So, we fall back on institutions, the post office savings and the saving account in commercial banks. Let us understand each one of these. Post office savings. Post offices are present in every locality. Any citizen can open an account. A nominal interest is paid to the depositor. Depositors can withdraw any amount so long as minimum balance in the account is rupees 50. A passbook is provided to keep account of deposits and withdrawals. And in this manner, post offices facilitate the movement of savings. What about commercial banks? We open a savings account in commercial banks. Banks accept deposit from the public. So, anybody can go and ask for an account to be opened. Minimum amount required to open an account and to be kept in the account is decided by the bank. Usually it varies from rupees 500 to 1000. A nominal interest is paid to the depositor. A passbook is provided to keep account of deposits and withdrawals. What happens when we save? Are these savings utilized? Let us now understand the uses of savings. Savings are utilized for lending and borrowing. That is, those who save can lend their money to those who need to borrow. We all borrow money when we need to buy assets. Many people keep savings in banks. These are surplus from present consumption. There are others who consume much more than what they can earn, so they borrow. The surplus from the depositors is used to lend money to the ones who need to borrow, and hence savings are facilitating lending and borrowing. Did you know that savings also contribute to the development of the economy? Let us understand how. Small savings of all individuals can be helpful in development of a nation through banks and post offices. Collectively, these become a large amount of money which is required to build the infrastructure such as roads, office buildings, flyovers, etc. to develop the industries. And so, savings contribute in their own way to economic development. Now, what happens when the depositor keeps savings in an account? Do we earn from savings? Yes, we earn what is known as interest from savings. When we give our funds in the banks give us an amount, and these are given to the borrower. The amount paid by the borrower for the use of services of the savings of lender is called interest. So, interest is a return for savings. So, the depositor earns interest while the borrower has to pay this interest. And who facilitates it? The bank or the institutions. Let us understand the meaning of rate of interest. The rate of interest is defined as the earning by the lender or the payment by the borrower for the use of every 100 rupees given by the lender to the borrower for a period of 1 year. And this rate of interest can be calculated by using this formula, that is the amount of money earned as interest upon principal amount into 100. Try this with your parents or your own passbook from the bank. Every 3 months at the end of a quarter, the bank gives you some rate of interest on your deposits. Calculate the rate of interest that the bank is paying. Here we have an example worked out. A gave loan of rupees 1 lakh to B and earns rupees 15,000 as interest on this amount. Calculate the interest rate. Always in numericals, let us work out these quantities first. The interest amount is rupees 15,000. The loan amount is rupees 1 lakh. So, what will be the interest rate? The interest rate will be calculated as follows. Interest upon principal amount into 100, which is 15,000 upon 1 lakh into 100, and when we calculate it, it comes to 15%. So, the rate of interest is 15%. Let us now come to the next aspect of savings, and that is insurance. Actually, insurance is also a kind of saving. It's just that insurance gives us some further coverage along with our saving. Let us understand this. We need insurance. Why? Because we are living in a world of uncertainty. This means we do not know what will happen in the future. It is a kind of a hedge against uncertainties. Insurance is a service which ensures some compensation to sufferer against loss or damage to the person who has purchased the insurance policy. Insurance is just like a good or a product. Insurance can be defined as a financial product which can be purchased to partly or fully recover any loss happening due to events beyond the control of the insured party. There are some terms we need to be clear about in insurance, which is the insurer, the insured and the premium. Let us understand each one of these. The insurer is the seller of insurance service or policies, is called the insurer. An insurer generally charges from the buyer for his services. The buyer of insurance services or policies is known as insured buyer, who pays to avail the services of insurance. What about premium? The money paid to the insurer by the buyer or insured to purchase the insurance services or policies is called a premium. I am sure you have seen or you have yourself experienced the payment of a premium at a regular interval. Generally, it is once every year. Now, what do we buy insurance for? Over time, the amount of products, the number of products have been increasing. But over here in this presentation, we shall deal with three kinds of insurance products, that is auto insurance, health insurance and life insurance. Let us understand each one individually. Auto insurance. Automobile or vehicle is a durable good and has a long lifespan. So, the insurance policy is made with some terms. What can these terms be? In the first year, the vehicle is new. So, the insurance company charges higher money as premium. In subsequent years, the vehicle becomes old and its value falls gradually. So, the company charges less premium. Whenever there is any damage caused to the vehicle, the company gives the claim calculated on the basis of terms and conditions mentioned in the insurance policy. Let us now deal with health insurance. Health is a serious and sensitive issue. Anyone can be a sufferer at any time. So, insurance company offers health insurance policies to recover the expenditure on medical treatment on certain bases. What are these bases or terms? Or we can also call them criteria. Buyers have to pay a nominal amount as premium every year. Premium amount is low if a person buys the health insurance at a younger age. The premium amount increases as the person grows older. So, that is because older people are more prone to health problems than younger ones. Let us now understand life insurance. Life insurance policy provides the nominee of the buyer to recover the loss of life of the one insured. It is a financial security for the family. Remember, when you buy life insurance, you are not buying it for yourself, but you are buying it for your family in case of an unprecedented calamity or some kind of an accident happening in your life for which they lose you. In such a situation, life insurance savings are a real boon to the family. But if you are saving for that, you better be sure that you are saving a good amount and putting it in the life insurance. So, life insurance is a hedge against loss of life as well as a saving, because in case the policy term you are living through it, then the amount saved is returned with a certain rate of interest. Let us understand this criteria as well. The buyer has to pay a certain amount of premium to the insurance company. The company gives back the claim amount promised to the person after the time period is over. The amount can also be paid in installments by the insurance company on a yearly basis also. They call it the pension scheme in insurance. If the person dies in between, the claim is given to his or her nominee whom the person had nominated while buying life insurance. Besides these, there are other products as well in insurance: travel insurance, insurance for household goods, for house and against accidents. So, all these are having their own terms and conditions. With this, we come to the end of today's session. In today's session, you have learnt the meaning of saving, the use of saving, the need for savings, the concept of interest, the meaning and need of insurance, automobile insurance and life insurance along with health insurance. I hope today's session will generate further interest in the subject of economics and make you a better and a more aware citizen. Thank you.